The number on the closing statement is $287,000. Not cash you had. Cash you borrowed. The house is in Memphis. You've never been to Memphis. You saw it in a video walkthrough. The property manager says it's rented. $1,250 a month. Your mortgage is $1,780. You tell yourself this is normal. Everyone says you lose money on cash flow at first. Appreciation will make up for it. The tax benefits will offset it. You repeat these things at night when you can't sleep. It's been 34 days since closing. The tenant already called twice about the water heater. You approved a $740 repair over email while sitting in your actual job's conference room. You still work that job. You make $83,000 a year as a project manager. You will work that job for 3 more years. You refresh Zillow twice a day to see if the estimate changed. It never changes enough to matter. You are not a real estate investor yet. You are someone who owns an asset you cannot see, managed by someone you've never met, occupied by a person whose name you know only from a lease agreement you signed electronically. You tell people at dinner parties that you invest in real estate. This is technically true. It is also a profound exaggeration of what you actually do. You do not invest. You wait. You service debt and hope the market moves in your direction. You buy the second property 11 months later. Another video walkthrough, another city you've never visited. Birmingham this time. The numbers look better. $1,290 mortgage. $1,575 rent. Positive cash flow of $140 a month after setting aside reserves. You feel like you've figured something out. You have not figured anything out. You have found a property manager willing to answer your emails and a market where the numbers accidentally work. You are still afraid every time the phone rings with an unfamiliar area code. The furnace dies in January. $2,100. There goes 15 months of cash flow. You pay it. You don't think about whether this is worth it. You think about the YouTube video that said you need 10 properties to replace your income. You have 2. You are learning that real estate investing is not about houses. It is about your tolerance for problems you cannot solve yourself, in places you will never go, with money you do not really have. Your friends think you're building wealth. You are building a very elaborate structure of liability and hope. You are 34 years old. You own 5 properties across 3 states. Your total monthly cash flow, if nothing breaks, is $890. Something always breaks. You have $1,400 in a savings account labeled reserves. It used to have $18,000. You spent $6,600 last year on emergencies. You still work your project management job. You make $96,000 now. You started listening to podcasts during your commute. Bigger pockets. Real estate rookie. You know the terminology now. Cap rate. Brrr. Cash on cash return. 1031 exchange. You use these words at barbecues. People are impressed. You do not tell them that you made $4,200 in actual profit last year across all 5 properties, before taxes. You do not tell them you could have made more working part-time at Target. You tell yourself you're playing the long game. Equity paydown, appreciation, tax depreciation. These are real benefits. They are also impossible to spend. Somewhere in the back of your mind, you know that if you liquidated everything today, after commissions and closing costs and paying off the mortgages, you'd walk away with maybe $65,000. You've been doing this for 4 years. You don't do the hourly math. If you did, you discover you've been working for $11 an hour. You keep going anyway, because stopping now would mean admitting that the last 4 years were a detour. You refinance 3 of the properties. Cash out refinance. You pull $78,000 in equity. You feel like you've unlocked something. You have unlocked debt. You use that $78,000 to buy 2 more properties. The cycle continues. You are not building wealth yet. You are building leverage. Your total debt is now $1.4 million. Your net worth on paper is $310,000. You have never seen $310,000. You cannot touch $310,000. It exists only in a spreadsheet where you subtract what you owe from what Zillow says the properties are worth. Zillow has been wrong before. You choose not to think about that. You are starting to understand that real estate wealth is theoretical until you sell. And if you sell, you pay taxes. And if you pay taxes, the wealth evaporates. So you don't sell. You refinance. You exchange. You defer. You are playing a game where winning means never cashing out. You quit your job. This is the moment you've been working toward. Your cash flow is now $2,840 a month. You have 11 properties. Your partner thinks you're insane. You might be. You have 6 months of expenses saved. You tell yourself this is calculated risk. It is partially calculated. It is mostly risk. You start wholesaling on the side. You join a local real estate meetup. You hand out business cards that say investor. You are not an investor in the way the person receiving your card imagines. You are someone with 11 mortgages and a desperate need to find deals because you no longer have a salary. You lock up your first wholesale contract, a distressed property in Detroit. You assign the contract to another investor for a $12,000 fee. You feel like you've made it. You have not made it. You have successfully brokered one transaction. The next 3 deals fall through. Inspection issues. Buyer backing out. Seller changing their mind. You make $12,000 over 4 months of work. You spend $9,000 on marketing and driving for dollars, and a CRM system someone said you needed. You net $3,000. Your cash flow from rentals covers most of your life. Wholesaling covers the gap. Barely. You're not sleeping well. You tell people you're a full-time investor now. You do not tell them that full-time means checking your bank account every morning to see if you can afford groceries. You are 38 years old. You have 26 properties. You stopped managing them yourself. You hired a portfolio manager who oversees all your property managers. This costs you 4% of gross rents. You don't care. Your time is worth more than that now. You have started buying differently. You're targeting C-class neighborhoods in appreciating secondary markets, Huntsville, Boise, Spokane. You underwrite deals in your sleep. You know the numbers before the broker finishes the pitch. You can smell a bad deal from the photos. Your cash flow is $11,300 a month. Your actual take-home after the portfolio manager and reserves and unexpected costs is closer to $8,000. You live on $6,200. You funnel the rest back into deals. You have a line of credit with a private lender, $500,000. You pay 9% interest. You use it to close fast on distressed properties. You renovate. You refinance. You rent. You repeat. You said you'd never pay 9% interest. You were wrong about a lot of things. Speed matters more than rate when the deal is right. You've started to notice that other investors come to you now. They ask what markets you like. They want to partner. You say maybe. You never follow through. You learned early that partnerships dilute returns and multiply problems. You are not building a team. You are building a machine that runs without you. Almost. Your portfolio is worth $9.7 million. Your debt is $6.4 million. Your equity is $3.3 million. You have never touched that equity except to buy more property. You are 42 years old. You own 58 properties across 7 states. You take 2 trips a year to visit your markets. You walk through properties with contractors. You have coffee with property managers. You shake hands with brokers. These trips are not about the properties. They are about maintaining the relationships that send you deals before they hit the MLS. You have stopped wholesaling. The margins were too thin and the effort too high. You focus only on buy and hold now. Your monthly cash flow is $31,400. You live on $11,000 a month. You bought a house. You paid cash. $340,000. You told yourself you deserved it. You did deserve it. You also removed $340,000 from your investment capital. The opportunity cost haunts you quietly. You could have bought 3 more rentals with that money. You don't talk about this at dinner parties anymore. Your friends make $80,000 to $150,000 a year. They ask how many properties you have. You say around 50. You do not say 58. You learn that precision makes people uncomfortable. They want to admire you. They do not want to feel small. You have gotten very good at making your success sound smaller than it is. You sell nothing. You exchange everything. 1031 exchange after 1031 exchange. You sell 4 single families in Cleveland. You buy a 22-unit apartment building in San Antonio. You sell 7 properties in Memphis. You buy a 38-unit in Oklahoma City. You are consolidating. Single families are management intensive. Apartments scale. 1 property manager, 1 roof, 1 address. The numbers are larger, but the principles are identical. Debt, leverage, appreciation, cash flow. You are not taking chips off the table. You are moving them to a bigger game. Your equity is now $6.1 million. You have never seen $6.1 million. You have begun to understand that you may never see it. The moment you liquidate, the taxes consume 30% of it. So you don't liquidate. You leverage. You pull equity through refinancing. You use that equity to acquire more. The system rewards people who never stop. You have become someone who will never stop. You are not sure if this is ambition or addiction. The line dissolved somewhere around Property 30. You are on the board of a local real estate investment association. You speak at events. You do not charge for this. You do it for deal flow. Newer investors approach you after panels. They ask how you started. You tell them a version of the story that removes the fear and the mistakes and the years you weren't sure it would work. You make it sound inevitable. It was never inevitable. You got lucky 4 times. The market appreciated when you needed it to. A tenant stayed when you expected turnover. A contractor finished on time. A lender approved a deal they should have declined. You do not mention this. You mention systems and discipline and underwriting. These things matter. Luck mattered more. You have 3 people who bring you deals now. A broker in Tampa, a wholesaler in Memphis, a turnkey operator in Kansas City. You close deals over email. You wire funds. You never see the properties until after you own them. You are not investing in real estate anymore. You are investing in relationships with people who have access to real estate. This is a subtle but important distinction. Your portfolio is 340 units, a mix of small multifamily and a few single families you haven't sold yet. Your equity is $14.7 million. Your cash flow is $64,000 a month before debt service and expenses. After everything, you take home about $87,000 a month. You pay yourself a salary of $22,000 a month. The rest stays in the business account. You have $1.1 million in reserves. You sleep better now. You haven't had a tenant emergency that truly worried you in 2 years. You have systems, you have people, you have redundancy. One property manager quits. You have another lined up. One market softens. You have 6 other markets. You used to think diversification meant different neighborhoods. Now you know it means different metros, different asset classes, different debt maturities. You refinanced 40% of your portfolio last year to lock in long-term fixed debt before rates rose. This saved you $19,000 a month. Timing. You were not smarter than the market. You were paying attention when others were not. You started talking to a syndicator about going in on a 140-unit deal. You would be a capital partner. $600,000. Passive. 12% projected returns. You said no. You do not invest passively anymore. You've seen the projections. You know what gets left out. The sponsor promotes. The acquisition fees. The refinance fees. The asset management fees. The disposition fees. You'd rather control your own deals and keep the fees. You are not building wealth for other people anymore. You do not call yourself a real estate investor. You call yourself a portfolio manager. You allocate capital. You assess risk. You manage people who manage properties. You own 14 apartment buildings, 680 units total. Your equity is $41 million. You have a net worth you cannot spend. You take distributions monthly, $120,000 after all expenses and reserves. You pay yourself $30,000. The rest reinvests. You are looking at a 240-unit acquisition in North Carolina. $18 million purchase price. You'll put down $4.5 million. You'll pull that from a blanket refinance on 3 other properties. The debt markets have shifted. You are now shopping lenders like you used to shop properties. You talk to commercial brokers about CMHF loans, agency debt, bridge financing. You understand advance rates and DSCR and debt yield. You speak a language you didn't know existed 15 years ago. You have a lawyer. You have an accountant who only does real estate. You have a bookkeeper. You have an acquisitions analyst who underwrites deals before you ever see them. You pay $340,000 a year in salaries for your team. This seemed insane 3 years ago. Now it seems obvious. You cannot scale without people. You tried. You failed. You hired. You scaled. You sit in a conference room in Charleston. You are being pitched a $68 million portfolio sale, 1,100 units across Alabama and Georgia. The seller is a private equity fund unwinding a position. You are not the buyer. You are part of a buyer group. 4 other investors like you. You're pooling $21 million. A lender is covering the rest. You've never met 3 of the 4 people in this room. You know their reputation. That's enough. The deal closes in 90 days. Your share is 18%. Your equity contribution is $3.8 million. You wire it from a revolving credit facility you established with a regional bank. You pay 7.2% interest on that facility. The projected cash-on-cash return on the deal is 11%. You are arbitraging debt, borrowing at 7, returning at 11, keeping the spread. This is what sophisticated investors do. You are a sophisticated investor now. You're not sure when that happened. It happened slowly. One deal, one lesson, one mistake, one success, compounded over 16 years. You have not used a property management app in 4 years. You have people who do that. You haven't walked a property in 18 months. You haven't spoken to a tenant in 3 years. You review reports, monthly financials, occupancy rates, rent rolls, delinquency trends, CapEx forecasts. You make decisions from those reports. Sell this, refinance that, replace this manager, increase rents here, defer maintenance there. You are managing a portfolio the way a fund manager manages stocks. You don't love the properties. You love the returns. You don't visit the cities. You visit the spreadsheets. You have become efficient. You have also become distant. You're not sure what you've lost. You own pieces of 29 different apartment communities. You couldn't tell someone what the lobbies look like. You filed that away a long time ago. You are not building a real estate portfolio anymore. You are building a cash-flowing entity that happens to own real estate. The distinction matters. You are wearing a suit you didn't used to own. You are sitting across from a family office out of Dallas. They want to invest $15 million with you. They've seen your track record. They want access. You would structure a fund. You'd be the GP. They'd be the LP. You'd take a 2% acquisition fee and 20% of profits after an 8% preferred return. You say you'll think about it. You've already thought about it. The answer is no. The moment you take outside capital, you take outside accountability. You answer to someone. You report. You justify. You lose control. You've spent 17 years building control. You're not giving it away for a management fee. You are one of maybe 40 people in the country operating at this level independently. No fund, no investors, no board, just you and a portfolio worth $160 million with equity of $74 million. You could retire, you won't. You don't know what you'd do. This isn't a job anymore. It's not a hobby. It's an orientation. A permanent state of acquisition and optimization. You haven't stopped looking at deals. You looked at one this morning. You'll look at another tonight. Somewhere in a different city, a 29-year-old closes on a duplex in a neighborhood he's never seen. He's terrified. He's excited. He thinks this is about money. He's already wrong. It was never about the money. It was always about the architecture underneath. The spreadsheets, the systems, the tolerance for risk that most people will never develop. The willingness to owe millions to become worth millions. The machine doesn't stop. It just finds new people to run it.